Well, good afternoon, everybody, and welcome along to our online webinar this afternoon. That looks at some of the challenges of the recent market conditions that are having on business today. My name is Kevin Marriott from IPSX, and I am very happy to host this session this afternoon. We have a great panel of speakers, which I'll come on to shortly. I think it's fair to say that almost every business across every sector in the UK has been affected in some way or another by coronavirus. And in this afternoon's session, we're going to be discussing the options now that corporates perhaps might have when thinking about capital raising and options for raising new finance, something that is desperately going to be needed by many businesses. There's going to be quite a lot of audience interaction this afternoon, and it's going to be your opportunity to have your input into the session. So please stand by and be ready to get involved in some of those polls that we're going to be bringing out to you. And just like any other Zoom webinar, there's also the option for you to put any questions or points that you want to make to the panel simply by using the Q&A box that you can see either in the bottom of the panel, depending on your Zoom layout, or at the top of the panel. So if there's any questions or points that you'd like to put, please do use that. And at the end of the session, I will come back and ask those Q&As and put them to the panel. But let me first of all start by welcoming our guests. And if I could ask the panel members to take themselves off mute, that would be really helpful. And first of all, let me welcome Dominic Burke, who's Head of Corporate Valuation Services from CBRE. Good afternoon, Dominic.
Hi, Kevin. Thank you.
And a very warm welcome to Mark Roberts, a partner at Grant Thornton. Good afternoon, Mark.
Good afternoon, Kevin.
Hi. And lastly, but no means least, of course, hello to Roger Clark, who is the Managing Director at IPSX. Hi, Roger.
Hi, good afternoon, everyone.
So before we make a start, let's remind ourselves of what we're talking about here in terms of the size of the corporate occupational market. And here are a few facts and figures just to kick the session off. In 2017, a report was published by the Property Industry Alliance that stated that the commercial real estate sector was estimated to have a value of some 883 billion. That was a few years ago. So no surprises, that's probably gone up a bit by then. And just over half, or 55% by value of this property is rented, which leaves around about 45%, or a little under 400 billion pounds of property in owner-occupier hands. And these could be science parks or offices, maybe even football stadiums or distribution centres. It's a wide variety and a very big number. But before we talk about what that means and how that could be of interest to the investment market, let's make a start by thinking about what's happening in the corporate market today. And I'm going to open, first of all, with our first poll of the afternoon. And what we're going to do is ask you a question. And what I'd like you to do is to answer that question just by simply clicking yes or no. And then what we'll do is we'll come back and ask you the same question right at the end of the session and see if you've changed your minds. So without further ado, let's have that first question, please. So the question is, do you think owner-occupiers of real estate should be thinking about releasing capital from their real estate assets in today's environment? And just simply, please, give me a vote of either a yes or a no. That's it, just click. And please submit your thoughts now. Unfortunately, panelists were not allowed to vote. So unfortunately, we're excluded from this part of the exercise. Okay, so thank you very much for taking part in that. And could we have the answers, please, or could we have a summary? So quick snap poll there. Gives us a pretty even number, actually, 54% saying yes and 46% saying no. So an interesting statistic. Thank you very much. Let's take that away and we'll get cracking with our session for the afternoon. And as I say, we're going to come back and ask exactly the same question at the end of the session. So panelists, no pressure for your contributions this afternoon. Right, so let's make a start. Roger, I'm going to come to you first, if I may, and perhaps you could set the scene for us a little bit about IPSX, how it came about, where we are on the journey, why it was formed, and particularly how this new exchange could help corporates at this most difficult and challenging time. So, Roger, would you like to take us through your thoughts on that?
Sure. Thank you, Kevin. So, I mean, at its simplest, let's just remind ourselves what IPSX is. It's a stock exchange which is dedicated to commercial real estate. So as an exchange, we're fully regulated by the FCA. In terms of regulatory approvals, we're completely equivalent to other large exchanges, like obviously, for example, the London Stock Exchange. But the difference is we list companies that own single pieces of real estate or very concentrated portfolios of similar assets. So you sell shares to the public in an IPO, just like with any other listed company on a stock exchange. And importantly, this means that going forwards, the owners of those shares, the shareholders, can buy and sell them at any time they want to by using a system of market makers. Those market makers quote firm two-way prices all through the trading hours every day. So we don't see gating, as has been seen in some of the retail funds, and we don't see any fake pretend liquidity like we've seen in some of the technical listings that hit the headlines last summer. IPSX is what's called a MiFID II compliant platform. What this means is that the shares can be owned by absolutely anyone. They can be held in a SIP or an ISA. And that is a key difference that IPSX therefore is going to make to the real estate sector. It means that any investor, even the man in the street, can now own a share of even the largest real estate assets, which up until now could only be owned by the largest institutions or private equity firms or sovereign wealth funds. So why is that interesting to corporate owners of real estate assets at the moment? I think before I start to go through some of the slides that we have here, I wanted to just make 4 points. There are 4 reasons why I think corporates should be thinking about IPSX at the moment. Compared to other choices that corporates have had in the past, it now means that you can release capital from your balance sheet assets without losing control. This is because, as with any IPO, you have to sell a minimum of 25% of the shares, but it therefore follows you can keep anything up to 75% of the shares. So you can retain a degree of control economically and, importantly, operationally over the assets that you need, which are vital to actually running your business. The second reason is that this can be done through a very standardized process. The IPO is a quick process. It can be done in as little as 2 or 3 months. It's very familiar to all of the professional advisors that a corporate would have, and it has a proven stamp of regulatory approval. I think the third reason that it should be interesting to corporates is that this process of opening up the asset class to everybody, if you like, the democratization of real estate as an asset class, means that you can attract new investors into potentially investing into your real estate. And I think where this can be really interesting for a corporate is that that could include your existing customers who might like the idea of investing into a brand or a company that they already know very well. And the fourth point, the last point, is that bringing all of this together, you can release cash from your business without having to take on any additional debt. This is equity financing. You don't need to take on any debt. And as I mentioned earlier, you keep control over operationally important tools for your business. And here's the last point. Compared to previous options that corporate owners may have had, because it's a listed company, you retain the flexibility, the choice to perhaps repurchase the assets one day into the future if you want to. So Kevin, can we move on to the next slide? So here we just set out, as I say, the previous options that corporates had were really to either sell an asset and lease it back, or maybe enter into some sort of joint venture. I think the key point, just to re-emphasize this about IPSX, is that when you are active in the real estate capital markets, you have a limited pool of investors, the people who buy real estate assets at the moment. What the flexibility of an IPO does is it opens up a much larger pool of potential investors. Kevin, next slide, please. So a little bit of detail here. We have two markets. We have IPSX Prime, which is intended for stabilized income producing assets. What would a corporate do here? Well, to keep it as a very simple example, the corporate would effectively separate out its property asset into a holding vehicle, an SPV, a PropCo, and that would then be IPO'd on IPSX and the shares would be sold. The company would then lease the asset back from the PropCo. Now, of course, depending on how many of the shares the company retains, it will both at the same time be paying rent to this company and receiving dividends from it. We think that to really work, the asset value or assets in the portfolio values need to be above £50 million. This is not a rule, it's just a guidance. We think that's where it starts to get interesting for investors, and we think that's where it starts to become probably cost effective for the corporate. A prospectus would be issued, which is pre-approved by the FCA. As I said, there's a minimum of 25% free float or shares that need to be sold to the market. This market has a limit on leverage. There doesn't have to be any leverage in this PropCo, but there can be, which can increase returns for investors. And subject to satisfying other parts of the REIT legislation, and all of the advisors on the call will know there are certain implications for a corporate, but subject to that, IPSX is a recognised stock exchange for the purposes of HMRC, so companies could elect to be REITs. I mentioned that there is a quote-driven trading system run through market makers, along with daily auctions, which help provide liquidity. And the minimum trade size is one share. You can own as few as little as one share, if that's what you want to do. And importantly, as I say, this market is open to all investors. So this is, if you like, thinking in terms of property funds we're used to by analogy for core and core plus assets. We have a second market, which is brand new in early 2020, called IPSX Wholesale, which is open to slightly more varied types of real estate strategy. So rather than just being for assets which are stabilized and producing income, it could be for development assets, it could be for refurbishments. It could, in this context where we're talking about corporates, it could be a way of raising development finance to perhaps refurbish, repurpose assets that are no longer core to your operating needs. Because this involves a slightly higher risk, higher return, the FCA has said that this market is not open to retail investors. It's only for professional or institutional investors. It means there's a minimum trade size of £50,000. But this means that there are fewer restrictions on leverage. The limit is set at 80%. It still means that the company could be a REIT. It means, because it's technically something called a multilateral trading facility, that there is no need for a prospectus to be pre-approved by the FCA. Rather, it could just be done by way of an admission document, which just needs to be submitted to us at IPSX as the exchange. That has a material impact on timing. It can be much faster. It could be as little as 6 weeks, we think, even before thinking about a slightly nuanced fast track process. And we have no prescribed minimum free float, which means, unlike with the prime regulated market, the corporate could actually retain even more than 75% if it wanted to, whilst releasing a little bit of capital from the asset. Kevin, next slide, please. So here, I just want to make the point that these are companies which are IPO'd onto IPSX. So as with any company, it needs to have a board of directors, independent directors. The corporate could nominate a director to the board, but a majority would need to be independent. That board is responsible for strategic decisions of this propco. That would include ongoing obligations from being a listed company and engaging with shareholders in terms of updates and disclosures and ensuring equality of treatment. These companies would follow some form of corporate governance code. We've mentioned 3 there which would be applicable. Again, companies' professional advisors will be very well versed in this and will be able to explain that to them. And to the extent that the corporate has its own property team, as many will, they could actually retain the asset management role and be remunerated for that by the propco, if that's appropriate. Not necessary, but possible. Kevin, next slide, please. Now, it's very important to understand why would investors be interested in investing into assets that are currently corporate owned and would be occupied on an ongoing basis by this single tenant. Well, one of the big attractions, and it goes back to a point Kevin made in his introduction, is that there's in excess of 400 billion pounds worth of real estate assets in the UK today, which are owner occupied. Now, not all of these would necessarily be interesting to investors, but a great many of them would, and they are currently not available to invest in. Investors like new products, new tangible product. This would appeal to professional real estate investors just as much as the man in the street I mentioned earlier. The transparent market pricing is a very important point as well. There are today massive seams of capital which don't invest into real estate, and largely they don't do that because they need, for various reasons, daily pricing, transparency about what the asset is worth. Obviously, if we take single pieces of real estate and admit them to trading on our exchange, where there is daily pricing from market makers, we're actually at the asset level creating something brand new. And I think it's really exciting just how large a pool of capital we will be able to attract to the market. And lastly, regulation and protection. Real estate is often perceived to be very much a closed shop where only those in the know really know what's happening, how to value the real estate, how to buy and sell it. And if we put a very standard corporate wrap around the assets, and that corporate itself and the whole process around its disclosure, valuation and trading is regulated and protected by the FCA, that immediately makes the asset class feel safer and more accessible to a huge new pool of capital. All of those things will make real estate more investable to more new sources of capital. And we think, other things being equal, that's only a good thing for all of us. Next slide, please. Over to you, Kevin.
Thank you very much, Roger. Thank you for sharing that with us. We've already got a couple of questions coming in, and please do keep them coming if there's some thoughts there that you've got as a result of hearing what Roger has to say. There was a bit of detail in there about the 2 markets, of course, with prime and wholesale, but there was also a little bit of explanation about how the relationship between operating companies and property companies with ownership of those assets might work. And I'm sure that's going to be a point that we'll come back to shortly. But to get us going, let's now hear what Dominic and Mark have to say to some of those ideas and some of those points and thoughts that Roger was sharing. And to get us started, I'm going to put a big question to, first of all, to Dominic, and then Mark, I'm going to come to you with that same question. So really, I think, given your experience, Dominic, of working across so many sectors, and if I understand it rightly, you are, and I'm sure you're going to explain a little bit more, with your experience of working with corporates at the moment, as we start to emerge out of this horrendous position with coronavirus, what do you now begin to see that corporates are asking themselves, and particularly, what do you see them seeing happening with their balance sheets?
No, absolutely. Thank you, Kevin. So just to briefly explain a little bit more about my role within the CBRE. So I lead the corporate valuations team. We're a cross-border valuation team focusing only on owner-occupiers and fundamentally their freehold assets. So that can be for any particular reason, really. It might be for accounting, it might be for loan security, it might be just for their strategy. So we focus just really on some of the world's largest occupier clients. Clearly, as you said right at the onset, Kevin, these companies are going through a very challenging time, particularly now with their ongoing operations, whether that be their people, whether it be their customers, whether it be just their ongoing cash flows. There are a myriad of current issues. I mean, obviously, some of the hardest hit sectors, hospitality, retail, are fundamentally just focusing on staying above water, but others are now starting to plan for what might be a new normal. How is the world and how are these industries going to look like when we move out of this, when we move away from the pandemic? And I think, obviously, it's accelerated from our perspective certain trends which were already happening across business and across the world. The issues with retail, certainly with bricks and mortar retail, the growth of online shopping, I think that's going to continue, and it's going to continue faster. We see there's going to be a greater move towards flexible working. Also issues with sustainability. I suppose this hasn't been talked about too much, but with the lockdown, there's been significant decrease in the amount of CO2 being released. And again, this is just going to further emphasize how corporates are going to have to deal with this new normal when they move out of it. Other issues which have come about during this period, the challenges we've seen with supply chain, the question marks around globalization, the reliance upon Far East for manufacturing certain goods. I think this all impacts business, and it impacts how they're going to have to come out of this going forward. And both of these areas, whether it be the immediate lack of shortage of cash flow or the long-term requirements to make structural changes, require cash, require investment. And we are now seeing corporates who are looking at ways and how they can use that real estate to raise capital. Obviously, the common themes have always been sale and leasebacks, whether it be income strips, etc. But I think obviously IPSX offers a new alternative for companies to both initially plug the cash flow in the balance sheet, but also raise capital for further investment as they do look to restructure and reorganize their businesses going forward.
Okay, thank you, Dominic. That's really a very useful summary, I think, of your experience and particularly some of the pressures that you're beginning to see firsthand with the advice that you're giving. So, Mark, let me come back to you and to your work with Grant Thornton. And I'm sure you'll be very keen to share some of your experiences and observations at the moment. I mean, clearly, there's a huge amount of pressure now on businesses with costs.
Yeah, no, thanks, Kevin. Absolutely. I mean, we're in the middle of something that's quite exceptional, but I think the organisations are now coming out of the shock factor and saying, what strategically do we need to do? Yes, of course, sure, the balance sheet is number one, but close behind it, recognising that everybody now is long on space. So office occupiers are wondering, what is the average population of their office going forward when we start to see a more stable environment? And that's probably 6-9 months' time. But I think what we're absolutely focused on at the present moment is helping large corporates understand what property they occupy, how they could occupy it in the future, and crystallize really how much space they probably have surplus as a result of this. Now that's obviously having concerns if they're a freeholder or a leaseholder, but it's also turning into opportunity. So some organisations are saying we're able to move out of aged property into more modern property at a discounted rate, looking to redevelop sites that are in the city centre and move to more suitable environments on the edges of cities, and make new manufacturing plants. And of course, government and councils are making some very attractive land available, and also made attractive funding packages available as well. So whilst it is a very dire situation, large corporates are now starting to move into the strategic lens of saying, how can we make the most of this? And how do we adjust our own footprint? And how do we put ourselves in the best position possible for a year to 2 years' time?
Very good. Okay, so let's just keep with this theme around shift and change, and particularly how corporates are beginning to react with their balance sheets. And let's come back to this big question about real estate assets which they own. So let's just bring this point back out. So thinking about these options, and Roger set out for us some really interesting ideas about how a public market might be able to help with that. So thinking back to these points around where real estate finds itself, how it sits on the balance sheet. Dominic, let's come to you. How, in your experience, how are corporates accounting at the moment for where their real estate assets sit?
No, of course. So I think the point has been made already. On corporate balance sheets, real estate really does play a significant part. I think of the global Fortune 500, the top 10 companies there, they've got real estate on the balance sheet in excess of 100 billion. It's such a huge, significant sum. Now, typically, how corporates would account for this is at cost. Corporates are allowed to either account at fair value, i.e. market value, or at cost. Now, the cost is typically what the property was purchased for, the time of acquisition, or what it was constructed for. Then this is then depreciated over a period of time, which would be the useful life of the asset. Now, the issue you find here is that isn't really how real estate markets work. Cost does not equal value. So often you find that real estate is held at levels which are not actually realizable. So we've seen this happen in many instances, that this can actually impact the business and their business's decisions going forward. So that might be if they were looking to exit from a property, exit from a factory, for example. If the book value, which has been held at cost, is too high, the implications of selling that can be quite significant in the balance sheet, and therefore can prevent them selling it. So that's kind of our experience really on how corporates do account for their freehold assets. Obviously now they've been changing with regulations with leasehold, with IFRS 16, where now leases are held on the balance sheet also. Okay,
very good. So audience, stand by. I'm going to come back to you in a minute to get some reflections on you and another question that we've got. But before I get to that, and please also do keep your questions coming, we've got a very appropriate question that's just been raised by one of our audience. And Roger and Mark, I'm going to come to you, if I may, to put this question through to you, and perhaps you'd like to reflect on the answer. So the point that's come in is thinking about these options that corporates are now facing. Clearly, there's the conventional approach, the traditional approach of sale and leaseback. But specifically, how do you now see with a public market in play, sale and leaseback working versus what we now have as a public market? Mark, let's go to you first of all with that, and then Roger, may I come back to you for some remarks?
Yeah, I mean, we've seen obviously certain PLCs make their announcements today on property companies, and the biggest challenge is Dom's probably having the biggest nightmare at the present moment on knowing where to sign off on valuations and what is the value of property at the moment. A bit of a cerebral moment, but if you take it back to a more basic level, I think sale and leaseback obviously relies upon, as we all know, red book valuation. People are nervous at the present moment to know whether they're selling it in the wrong market or having to sell it, and will they get maximum price, and will they face criticism from their shareholders in the future. I think the interesting thing, and why we're looking at IPSX for a number of projects we're exploring at the moment, is the fact that the red book is parked to one side, and IPS start to look at the future value of the redevelopment site or opportunity, and therefore protects the board against any of those negative criticisms. So for me, sell and leaseback will always be considered and always be one of those options that should be measured. But I think IPSX should be looked at in comparison. And it depends on the board's objectives. Are they wanting to have long-term control? Are they looking for short-term benefit to shore up the balance sheet, or even use it as a war chest for M&A activity? And I think yielding greater levels of return using IPSX than a sell and leaseback, but yet maximising control.
So let's just hold that thought of control. Roger, let me now come back to you, because it's an important point. And clearly, if I'm an owner and an occupier, I've got complete control of what I do with my building, how I choose to use it, and how I choose to do that. Now, clearly things change if I don't have that responsibility or control anymore. So thinking about the IPSX example, how therefore would that control aspect change? And you talked earlier about property companies and operating companies.
Well, a lot of what I said earlier on, I was assuming that the original corporate occupier may retain a large enough stake in the company going forwards that it would have possibly literally voting control and economic control more than 50%. They don't have to do that, of course. But I think it follows that you don't have to own 100% of an asset in order to have influence over what happens to it. We only need to see that, for example, in the takeover code, the mandatory obligation to make a bid for the whole company comes in at 30%, because that is the point at which the takeover panel think you've effectively got control of a company. So I think that what's important for corporates is that they have the use of the piece of real estate in order to actually get on with what they really want to do. I don't think most corporates are really owning real estate in order to be property investors. So to me, it's a question of the operational certainty, the operational control that you have. As I mentioned, the original vendor, the owner-occupier, the corporate, can have a seat on the board. As a shareholder, they would have rights to vote, subject to, without wanting to get into nitty-gritty, subject, of course, to things like related party rules and so on. So I think the key point is that this idea that once you don't own 100% of something, you're just a total passenger in what happens to it, probably isn't quite right. Okay,
thank you. Dominic, I'm just going to come back to you, last point on, if I may, on FRS 16, and then we're going to go to our audience and keep going with your questions. There's an amazing amount of questions coming in. So clearly we're resonating well with the audience. Dominic, question for you. What would you say has been the impact of FRS 16 on sale and leaseback?
Yes, of course. So I think before the introduction of IFRS 16, sale and leaseback was quite a succinct way, really, of taking the asset off the balance sheet. So it wouldn't be a balance sheet liability. Now, as all leases, particularly over a year, are now recognised on the balance sheet, there are implications associated with that. I mean, nevertheless, they still do remain a relatively popular tool in many instances to raise capital, but there are now accounting issues which do detract from that to a certain extent.
Okay. Mark, anything that you wanted to add to that, or has Dominic pretty much covered it?
No, perfect answer.
Okay, very good. Right, audience, it's your turn. Let's get our next question up. And let's see what you have to say to this. And again, simple yes, no answer. So let's have that next question, please. Okay, and it's very much reflective of the discussion that we've just been having. With corporate balance sheets or cash flow under renewed pressures, should companies be taking on more debt, even if interest rates are at a historic low? So let's have your votes, please. Yes or a no to that. Okay, let's close that poll and let's see if we can get some instant results on what we all think. There we go. Yes have gone for 42% and 58% say no. Panel, any thoughts on that? Is it what you would expect? Mark, you need to take.
I guess
Mark,
I'm not surprised at that. I
No.
perhaps would have thought the negativity towards debt might be higher. It's an odd time we're in at the moment, because some people have even gone as far as to say that with servicing costs of debt so low, it kind of stops being too much of a liability. Now, of course, that's slightly nonsense, because of course it's always a liability, and we shouldn't get confused with how easy it is for governments to manipulate QE with how debt is for corporates. Meanwhile, equity is not a liability. Unfortunately for investors, this is proven to be the case recently with investors in shareholders in companies like Shell and the large banks realizing that these dividends are completely optional. So at a time when corporates need to think about cash flow, think about either maintaining it, or as Mark was alluding to earlier on, perhaps wanting to even raise it opportunistically, using equity rather than debt at the moment seems a more prudent way to go if you can.
very good. Mark, anything to add to that?
I agree. I mean, obviously, at the present moment, as we said, we're technically in week 7 of lockdown. The mindset is about survival. It's not about growth or expansion. We've only seen, probably in the last 5 days, organisations contacting us who are thinking about strategic long-term decisions and looking around, how do they fund it? So I think there has to be a purpose. So to take on debt, there needs to be a need or a purpose that strengthens the company or puts in a better position as we come out of it. But it's an understandable poll, is what I would say. But I think if we ask that in 10 days' time, it probably would flip.
Okay, very good. Thank you. Let's take the poll away. So let's close that down. Thank you very much. So let's continue the conversation as to where we got to just before I asked those polling questions. So I think the big point now for me is to ask the panel their thoughts about this debate between whether I should own or whether it's better for me to rent. And of course, there are benefits to both of those. But given the situation that we're in right now and looking forward for the next sort of 2, maybe even 3 years now, is flexibility now going to become even more of a requirement when you're thinking about this big conversation, this big debate about whether I want to continue to own my assets or indeed whether I want to now move and think around a rental position. So Dominic, let me come to you first. Again, with your work that you're into right now, what's your position here? What do you think? Are owners, owner occupiers now beginning to think about perhaps moving away from what they are doing and perhaps freeing up some cash and looking at things in a slightly different way?
Yeah, I think certainly potentially. Real estate, I think, as Roger mentioned before, for the large corporates, it's a function of their business. They don't exist to be property speculators. They exist to either make their product or provide that particular service and to satisfy their customers. So real estate is fundamentally used to make them the most efficient or effective as they possibly can be. Now, the way organisations hold their real estate, it depends to a certain extent on how mission critical the particular site might be. So it very much does vary organisation to organisation and site by site as to whether own or rent is the most effective manner. For example, if you are a large pharmaceutical company and you have your production facility, which is in the area where you can attract the best talent, where you have a bespoke, expensive facility which you've built, in many instances you would say ownership there to a certain extent is better, because you therefore have certainty that you cannot lose that building, which is critical to making your business work. Where in other instances, as you pointed out, Kevin, flexibility is going to be key. The world is changing rapidly. This is accelerating many changes. So therefore, for the other types of real estate that organisations own, whether it may be shops for the retailers or office premises, which are going to go through changes in terms of the footprint that these businesses need, you would, in those instances, renting may well be better. So I think it really does vary organisation to organisation. Mm-hmm. And from a financial perspective, there's a number of factors, whether it be the cost of capital, the cost of debt, as to how financially it
Okay.
works in each instance.
Thank you, Dominic. That's helpful, interesting. So let's move over to Mark. You, I know, are working right across different sectors, not just the manufacturing side. Mark, is there anything more that you can tell us? Are there particular sectors maybe that are looking at this in a particular way? Is there any experiences that you could share?
Yeah, I mean, the major question here, which is linked, is how an organisation holds or owns property. I think it's back to the other point. We're starting to look at, as a result of the lower cost of capital, suppressed values in the short term, it's giving organisations the opportunity to explore how do we hold property. So I absolutely agree with Dom that long-term assets that are core to the business, that you're going to be in for 15 plus years, there is always a strong argument to say you should own them. But it's how do you own them? And should there be an SPV? Should you have a propco and an opco type of structure? Often talked about, but very rarely understood in full accounting and tax purposes. But if you can get efficiencies and become more of a professional landlord and use property more professionally, even though it's it's core to your business, but not actually the centre of your business, I think that's what we're starting to see. We're pushing these ideas to a number of clients, and this is a great opportunity. And I think more organisations are saying, for the very reason you raised, Kevin, we're not sure if we're long or short on space, but that's almost secondary. If you're holding it in the right way, and it is flexible, not only can you bring in potential joint venture partners to look at repurposing the land or redeveloping the land, but also you can disinvest without having to affect your balance sheet.
Excellent. Thank you, Mark. That brings me beautifully into another question I've got for the audience, which is very much to this point around the OpCo-PropCo structure. So could we have question number 3, please, for our audience to give us their views? So it is about this point. Is the transaction complexity, and Mark's been very well described there, some of the ins and outs of that, of creating an OpCo-PropCo structure to release capital from an owned asset, really worth the effort? So quick poll. Let's see what you have to think to this point. Either yes, you do, or no, you don't. So vote now, please. And Roger, just to give you a bit of warning, I'm going to come to you next on the results of this. Okay, very good. Let's close that poll. Excuse me, and let's see what those results are giving us. Right, a very clear and positive support for that idea. So, Roger, any thoughts on that?
Well, I have to say I'm slightly surprised and very pleasantly surprised by that. There's obviously a lot of far smarter accountants on this call than me. So I think that one of the things that always worries me is that these, as Mark was alluding to just a moment ago, these rather arcane structuring requirements maybe put people off. So I think that's great to see that it doesn't appear to. Obviously, there are lots of advisors who can shepherd people through the process, and that's a very pleasant surprise.
Okay, yeah, I think it's good to see that kind of positivity with our audience towards this approach. Okay, so please can we take that poll away? Great, thank you very much. And I'm going to come back to this wider topic that we've been talking around, which are, what are the options that corporates are now facing for capital raising? And Roger, we've got a question that's come in here that I'd like to come to you with, if I may. And I think we've proven the point through the conversation so far this afternoon, that this is the time to start really considering what the options are. And certainly public markets seem to feel like a good option for corporates to think about. But of course, we do already have another exchange in London. Roger, my question for you is, well, okay, so if I'm thinking about this, I'm an owner-occupier, I can think about releasing my asset, but there's already an exchange out there in London. Why don't I go over there? Why come to IPSX?
Well, I think one of the things that we have observed in recent weeks is, unfortunately, for the larger REITs, which are already listed on the LSE, and let's use the two biggest, most obvious examples, the large diversified former bellwethers, British Land and Land Securities, both fell by nearly 40% during March. People will remember the sort of nadir of stock markets was on the 23rd of March, which happens to be when we went into lockdown. And at that point, both of those companies were down more than 40%. They dropped even more than the wider stock market had. And the wider stock markets all over the world reacted to the increasingly obvious seriousness of the COVID-19 quite violently. Since when, as everybody will know, we've actually started the next bull market, because markets are now up nearly 25% since that point. And indeed, British Land and Land Securities, their share prices have recovered a little bit. All of which points to the fact that they trade in line with the wider stock market, and the UK stock market has traded in line with wider global markets. And that, I would say, is precisely not what you buy real estate for. Real estate is supposed to be a diversifying asset that has less correlation to these wider equity markets. We believe that because we are a dedicated exchange dedicated to real estate, we basically provide the best of both worlds. We give the returns that you want from real estate. We give real estate valuations and returns, whilst providing all of the regulatory protections, the liquidity and the daily pricing of a stock exchange. That's the reason why people should be using IPSX rather than the LSE.
Okay, thanks, Roger. Great answer, and very helpful. And I hope that answers the question that we've got coming in. And please do keep the questions coming in. We've got about another sort of 5 or 6 minutes to run. So plenty of time to get a couple more points into the panel. If you've got particularly burning points that you'd like to put to them. Now, team, we do have some other questions which I'm going to now just raise to you. Dominic, there is a question here about valuation. If I could just find it. Here we go. Managed to find it. Let me just read this back to you, Dom. So let's just get this right. So the question is, how does the retail investor know whether the valuation is fair or not, both at IPO as well as the daily quote provided by the market maker? And we'll come back to the jargon of market maker in a minute. But I think this is sort of relating back to what Roger was talking about when he was explaining these two markets of wholesale and prime. And prime, of course, is for this bigger, wider retail investor market, whereas wholesale is not. Wholesale is only for institutional investors. But both markets, of course, have to have a red book valuation provided to the asset before it comes to be admitted to either of those markets. So, Dominic, back to you. Sorry for the preamble. That question is about getting to that fair value price. Could you give us your thoughts on that?
Yeah, absolutely. So I think in order to produce a red book valuation, the surveyor needs to be suitably qualified, and it's qualified and it's governed and regulated by the RICS. And you have to be a RICS registered valuer, which goes through various protocols to ensure that the surveyor conducting the work is appropriately qualified and has appropriate experience to enable them to offer fair, independent, tangible results. So I think from our perspective, it's a well-regulated profession, and that should give confidence to the consumer, the retail consumer, that the numbers being provided are suitably, diligently considered.
Okay, and Roger, let's just open this up, come back to you if I may. So we've got another sort of subsequent point that's come in around, obviously in prime, we have a market maker market, whereas as in wholesale, as you explained, it's a slightly different structure. It's a different way of the market that works. And the point that's being raised on the questions that's come in for us is how does the market maker effectively set the price? Is that something that you could help us understand a bit more?
Well, market makers are effectively not in business to try and take directional positions. Usually, proprietary trading has been discouraged at banks. So effectively, they're trying to just provide liquidity, which means, forgive me if there are any market makers on the call, a little bit like a bookmaker at the races. They're trying to just make prices which provide liquidity whilst keeping a flat book. This means that, of course, if there are lots and lots of sellers, they will tend to move their prices because it's the nature of running a book, is that you try and match supply and demand. But I think what lies behind the question is often something that I get asked about, which is this relationship between discount to NAV and NAV in the market. An important difference that I would say will exist where we have a dedicated exchange with single assets is this. If you look at, again, let's use British Land as an example, it's currently trading on around a 30% discount to NAV, which means, other things being equal, if you go and buy a British Land share, you're hoping that that 70% of value might close closer to 100% of value. And you have no control over that. What you could do is you could go and buy the whole company, and effectively, having bought all of those assets at 70% of their value, you could now try and sell them for their value, and you could arbitrage that discount. In practice, of course, it's very difficult to do for a whole host of reasons, the size of British Land, but also the lack of transparency around what's in that portfolio. It could be that some of their assets are worth a lot less than 70% of the last valuation, etc., etc., etc. On the other hand, it gets very easy if you're looking at one building. If a particular building is being priced in the stock market at 70% of what it's actually worth, that discount will be arbitraged away, or someone will come and privatize the company. So there is always a much easier connection between price and value around a single asset than around a large portfolio. So we won't see prices materially move away from NAV. For another reason, if the yield at NAV is, for example, 5%, but the shares are trading at a 50% discount to NAV, i.e. the shares are yielding 10%, people will buy them. Those shares will be bought.
Okay, look, thank you very much, Roger. I think you've answered that really well and very clearly as well. So thank you. And Dominic, thank you for picking up the valuation point as well. It's a question we get a lot. So I'm sure this is a point that we're going to come back to all the time. It doesn't take much to always come back to this point about what's it worth and how do you get to that. So I'm sure that there'll be other points along the way where we come across this too. So I'd like now to, if I may, to go to our final question for the audience, question number 4, if we could bring that up, please. And this is about some of the accounting issues that we were talking about earlier on in the conversation this afternoon. And the question is very straightforward. Do you see the accounting issues that we've talked about, and indeed others, caused by partially selling owner-occupied assets as being surmountable? Is this now something that is doable? Answers, please. Quick poll. If you think it is, hit yes. If you think it isn't, hit no. So please vote now. Mark, I'm going to come to you, please, if I may, on your immediate reflections to the poll, and then Roger, and then Dominic, and then we're going to do our final question at the end and bring us to a bit of a close. So could we have answers to that poll, please? Mark, your thoughts immediately.
I'm not surprised. Yeah, I think it's probably the honest answer to that. I think it goes back to the earlier points around how one holds property and occupies it. With an awful lot of large organisations, surprisingly, some of the findings we have are they've almost lost track of what they occupy and where they occupy it. They've lost track of who's actually in their buildings. But the reason they're doing it is they have no internal charging mechanism. So I think in terms of overcoming this or addressing this in part is back to how do you hold it, and also how does your organisation use space and how is it charged for it. We've seen when you put charging mechanism in place internally, and we call them wooden dollars for whatever reason, people's behaviours change. And I think if they can change and get into an opco-propco structure, and you start to share the true cost of running a portfolio of buildings that underpin and support a business, then it becomes particularly efficient. And then you can look at the accounting treatments of that and cross-charge that across those businesses. So I'm not surprised, but I think there's more to be done.
Very good. Okay, thank you, Mark. Roger, brief thoughts.
Yeah, again, it's really reassuring. I mean, I often find people are slightly put off by the complexity of some of these transaction structures. So I do hope I'm wrong. And you know, with people like Dom and Mark around to help, I should be wrong.
And Dominic, any closing remarks to that point before we move to closing the session?
Nothing really extra for me, Kevin. I think Mark and Roger summed it up perfectly.
Great, thank you. So let's take that poll away, if I may. Now, would you believe we're coming to the end of what has been an extremely interesting hour? Would you believe that's what we've gone through? It seems to have absolutely shot by. Now, we started the session with a big question that we asked you as the audience. And I'd like to close the session, if I may, by asking exactly the same question. So let's see if we can bring that up, please. So the question remains, do you think owner-occupiers of real estate should be thinking about releasing capital from their real estate assets in today's environment? Having heard what the panel said, having heard what Dominic's been talking about, what Mark's reflections have been about options and the importance of flexibility in all of that, listening to what Roger has been saying about investor appetite, looking and being interested in finding and exploring new ideas, new opportunities. Let's have your votes, please, on this point now, if I may. And panel, what I'm going to do while our attendees are busy thinking about their response, I'm going to come to each of you for your closing remarks, if I may. If you want to refer back to what the stats tell us, please do. Otherwise, just give us your closing remarks, your closing thoughts on what I think has been a really interesting and fascinating session. And Dominic, I'm going to start with you, if I may. Mark, then to you, and Roger, I'm going to give you the closing words to the session this afternoon, if I may. So could we have the results, please, to that? So, okay, so here we are, 73%, so we've got a movement, are now saying that they agree, and 27% say they don't. So, Dominic, your closing remarks, if I may.
Great. Yeah, no, I think I've really enjoyed the last hour. It's been a fascinating debate, and it's great to have so much contribution. I think obviously we're in a dreadful time with the current pandemic, but it's positive that we have now this product to allow occupiers to have another option to release capital. So I think, and it's great that so many people are interested in it.
Thank you very much, Dominic. Okay, let's go to you, Mark. Your thoughts?
Likewise, been very valuable, very insightful. I think the most important thing is we're seeing a huge competition for capital as we come out of COVID-19. There's been funding instruments removed from the table, like PFI, that was formally retired in March by the government officially. And therefore, I think IPSX is a much needed instrument if we're going to start to see releasing of capital for large corporates or government and councils exploring joint venture. So I think it's an exciting instrument, and I'm very, very pleased to be working with you on this.
Great, thank you very much indeed, Mark. And finally, Roger, the floor is yours to close the session this afternoon.
Yeah, thanks, and thank you to everyone who's listened in, and thank you to the panelists. It has been a really interesting discussion, and I think that I'd just like to leave everyone with the thought that this is a time when everybody will be thinking about innovation. Everybody is thinking about how behaviours are going to change. I think that for companies to really think about what their businesses are for and what they're really designed to do, whilst at the same time being able to release tied up capital in an innovative way is really interesting for them. And most interestingly, I think that being able to try and engage with their customers a little bit more. Their customers are all the people who need dividend yields from asset-backed companies in their pension funds. And I think being able to create a new way of having a connection is something that just wasn't there before. And I think that's really interesting.
Great. Well, thank you, Roger, for closing on such a high. Thank you to Mark and to Dominic for giving up your time and coming on and being part of the big conversation this afternoon. And thank you all to our attendees, and particularly to those of you that have been putting forward your questions. I've never quite seen so many, so thank you all for that. The webinar has been recorded, and that we will be giving you the link to that. So if you want to have a listen, or indeed pass a link through to colleagues or contacts that you have, please do. And if you are would like to know more about IPSX, then please do come back onto our website, ipsx.com, and there you will find a lot of webinars that we've been busy recording, and indeed some podcasts too, about both of our markets of prime and wholesale. And if any of these points that we've been talking about today has pricked your curiosity, you'd like to know a little bit more about how we work and what we do, then please do get in touch. We'd love to talk to you. We'd love to discuss more about how our markets can help, and particularly at this most difficult and challenging time. So thank you all very much indeed. Have a wonderful rest of the day, and we look forward to catching up again with you very soon. Good afternoon and goodbye.
Goodbye.